He was a glue guy, playing both sides of the line in high school football and then a successful collegiate career as a rugby prop. He took those skills to Wall Street for a successful 25-year career, and today is putting them to use building a self-storage company. Today on Stories Behind the Door, we welcome the founder of Next Century Self-Storage, Adam Troso. Super excited for the conversation with today's guest. A lot of things that we're going to cover, from Cauliflower year to the GFC to what's going on in self-storage in 2026. Before I get into that, I'm going to introduce myself. I'm your host, Thaddeus Campbell, Director of Business Development and Strategic Branding at S3 Partners. We have 30 plus years, 300 plus ground up developments across self-storage, small bay flex, and boat and RV. If you have a piece of raw land and need help from entitlements all the way through construction, we can help that dream come to life. Want to give a quick shout out to our sponsor, the folks at Kiwi2 Construction, Wayne Woolsey and his team. I look out my window. They're building a 3-story facility right across the street from me. They've been providing steel structures for the self-storage business for more than 30 years. You can reach out to them at kiwiconstruction.com. That is enough talking about other folks for now. Very excited to welcome Adam Troso to the show, CEO and founder of Next Century Self-Storage, somebody that earned the automatic right for an invite onto the podcast. I met him up in New York City at the New York SSA event, was introduced by my friend Stan Bonilla. Adam has cauliflower ear, and that is an automatic invitation to come and join my podcast. So anytime I see somebody who's got a little, mine's not as pronounced as yours, but it's there. We're going to get to that. I asked the same question first of everyone that joins Stories Behind the Door, which is storage is such a niche industry. It's such a unique industry, but not one typically people set out to get into. How did Adam Troso find himself in self-storage?
Yeah, literally. Look, Thaddeus, I recently wrapped up a 25-year career on Wall Street, which started in the 90s underwriting CMBS loans at Paine Webber. And we were underwriting everything. And it was the 90s, and CMBS was hot. We were doing giant loans on office buildings, apartment portfolios, shopping malls, warehouse portfolios, and self-storage, right? I mean, fit into the bucket also. As a CMBS lender, we were sort of debt service coverage. We were a cash flow lender and really focused on DSCR. And in all these big, sexy office and mall deals, everyone was focused on trying to keep it at a 1.05 or better coverage ratio. We're looking at these self-storage deals, and it just occurred to me that this is the best way to actually make money owning real estate. The coverage ratios were 2+. The CapEx was de minimis. The operating margins were very high. The break-even occupancies were very low. Investors loved it, which kept the cost of capital down. And so just the strong cash flows, the diversified revenue stream, the diversified income stream, the granularity of the revenue stream, the lack of CapEx or the de minimis CapEx, the high debt service coverage ratios, the capital markets loved it. All those reasons drew me to that conclusion that this is the best way to make money owning real estate. Now, most of our clients wanted to buy office buildings and shopping malls and put them on the cover of their annual report and talk about owning XYZ building in Midtown Manhattan at the Country Club. My goal is just to make money, right? I don't need a glossy, I don't need a fancy picture on the cover of my annual report. I want fancy numbers inside the annual report.
It's so funny. One of the first gentlemen I ever met in storage, his daughter was going to Princeton at the time studying finance, and would tell him how unsexy storage was. And his response would always be, yes, until you get the financials, right? It's about the income. Do me a favor for the layman that's watching the podcast and doesn't understand DSCR. Break that down for me.
Well, it's just the debt service coverage ratio. And so you've got your cash flow that comes off the property. Or you've got your revenues and your operating expenses, and then you've got what we call net operating income, which is before CapEx, very important. And then you want to subtract out all your annual CapEx, and then the credit markets, we try to normalize that or kind of create an average over the life of the loan, and we'll take the same amount each year, even though in reality it'll be a little bit more lumpy. Then you've got your net cash flow from the property. And that is what a lender will underwrite and size the loan to. So if this is your net cash flow from the property, how much interest can you pay? And if you can pay X amount of interest, then you can afford so much of a loan. And that's how you kind of size up a loan. In things like office buildings or shopping malls or shopping centers, that net operating income margin is pretty good. Not as good as self storage, but very good. But then comes the CapEx, and you've got leasing commissions that you pay to brokers that put the tenants in place, which are very high. Um, you've got tenant improvements, which are can add up to 2 years of rent, right? So if you own a giant office building in New York City and you sign a giant law firm to come move into your building, they are going to require you to build out that space. That's just part of the competitive nature of landing a big office tenant. And building out fancy office space for big law firms is expensive, right? You got to buy all the materials, you got to put it in place. There's downtime, you got to build it, right? You got to get the old tenant out, you got to get the workmen in. They're putting in oak and cherry, cabinets and drawers and desks, and it costs a lot of money. But that all comes out of that net cash flow. That all comes out of the owner's pocket, just for the privilege of having a rent-paying customer down the road. In self-storage, you have none of that. There's no leasing commissions. Our marketing expenses are material, but nothing like the large CapEx numbers that you see in the office or the shopping center or the mall space that really whack cash flow. Ours have more of a operating expense look and feel to them than a giant CapEx investment. And same thing with tenant improvements. Our tenant improvements is we have our maintenance guy open up the door and he sweeps it out and it's broom clean and it's ready for the next person. That's pretty much it. So that's almost a $0 turnover cost. And that unit is ready the next day. In most other types of real estate, there's significant downtime, right? It takes a long time to get it released. It takes a long time to get the space built out for the next tenant. You could be down for a year on a space before you put in all the CapEx to make it ready for the next tenant. We have none of that in self-storage.
You said something fascinating to me. I was looking at an industrial asset a couple years ago, and we were speaking to brokers who could it was a ground up development. We were speaking to brokers who could potentially lease it out, and they wanted to sign an agreement at 6% of every lease for the whole length of the lease term, and then
Yeah.
upon renewal, get a
Yeah.
percentage of the renewal too. Right, where
Yeah.
pretty common in storage, especially on larger institutional level assets, where you're only paying 5% for a third party management company to come in
Yeah.
and manage it for you. And you
Yeah.
have no cost of a lease. Yeah, you have employees and you have folks that you need there, but that comparison is wild when you start breaking it down. And when you go into an underwriting model and a pro forma, there's a massive difference at the end of the day about what those costs do to your ultimate, what you said. Ultimately, it's about cash flow, right? How much money the project's going to make.
100%. And so look, the net cash flow margin after all that CapEx and self-storage is much better than other property types. But even the operating margin, the net operating income margin is better. It's much less labor intensive. There are no people that physically inhabit the property. There's no bathrooms. There's no kitchens. There's very few things that may break. Versus an apartment building or an office building that's got 12 different elevators and people flushing the toilet 100,000 times a day. There's a lot of things that can go wrong. But things go wrong in self-storage too. But the cost of replacing an elevator in a New York City office building, for instance, dwarfs the cost of repairing a door or a dent or a scratch in a self-storage facility. So the operating expenses, the repairs and maintenance, the number of people needed to run a self-storage facility, the labor is much less than other property types too.
I'm going to circle back to that. One of the things I heard, and it's going to open a door for me that I wanted to go down is there's a lack of ego in your approach, right? It's not about the how does everyone else look at what's happening. It's about what can the income generate it for. I want to go back. I'm going to go back to my favorite city in the world. I'm a Massachusetts guy by birth and went to school at Tufts, stone's throw
Yeah.
away from Boston University.
Yeah.
You went to BU and played rugby at a very high level, thus the cauliflower ear, where that came from. Talk to me
Yeah.
about rugby as a part of Adam Troso's life and how that has played a role in where you've gotten to this point.
Yeah, look, it means a lot. There's no more egalitarian sport than rugby, in my opinion. You've got 15 guys on the field at a time, no subs. Back in the day, there were no subs. You stepped on the field, you were finishing the 80 minutes on the field, and there is a high value position and role for every body type on that field. Um, and Look, I played offensive line in football in high school, and I played front row or prop, as they call it, in rugby in college. These are not glamorous positions. Um, we're not the good-looking guys with the nice haircuts, scoring lots of points and getting all the accolades. We're picking ourselves out of the mud, wiping the mud out of our eyes to see if we scored or not. Right? It's about being a team player. It's about digging in. It's about grit. Um, and it's about and to do well in a role like that, you can only be focused on one thing: team win. Just want to win, right? Just want to win because nobody's putting the number three, the tight head prop on the cover of the BU Rugby newsletter, right? It's number 13 or number 12 in the back who's scoring all the tries. So you just focus on winning. Team wins.
Talk to me about how that philosophy and that mindset helped you throughout the career on Wall Street and now into Next Century.
Yeah, I mean, look, it's again, as an advisor on Wall Street, right? As an investment banker at Paine Webber, at Bear Stearns, at JPMorgan, it's all about creating wins for your clients, right? I'm giving advice, right? That's what we did. We like money, but we gave advice. Gave advice on mergers and acquisitions, IPOs, strategic alternatives, capital alternatives, and it's all about setting up your client for wins, because whatever the transaction is, I was given this description of my role as an investment banker early on when somebody told me they said, "Look, you're not Luke Skywalker. The client is Luke Skywalker. You're Yoda, right? You're Yoda. Small, green, not that good looking, but full of advice. Give the advice and set your client up to be Luke Skywalker and go out there and slay the bad guys." And that's what we do. I do the same thing here when I transition to the principal role. My job, my role is to make money for my investors, my clients, still my clients, right? That's my role. That's my job, is to make money for them. And that's how I approach it.
I'm going to fast forward here in a minute. I want to ask one more question because you were on Wall Street 2007, 2008, the GFC hits. I'm fascinated to get your take on being inside that, what that time period was like. And then I'm, maybe follow up with what are the lessons that you take out of that as we're, coming into 2026.
Yeah. I mean, I had an interesting GFC story, if you will. I was at Bear Stearns and got a phone call, asked to make a move over to JPMorgan, which was literally across the street. So I walked across Park Avenue and had, 12 interviews with those folks, and decided that it was a better fit for me where I was in my career. I loved Bear Stearns, loved it. It was great. It was a very good fit for me for the time that I was there. But shown some alternatives, I thought JPMorgan was the right place for me to advance my career at that stage. And so I did make that move. Left behind some great friends, still great friends, but didn't get to see them every day. Bear Stearns collapsed 10 months later. I was on vacation with my family, and I looked at my BlackBerry and BlackBerry, right? And I said, "We bought what?" Like, I couldn't believe it. I mean, my phone just rang off the hook because everybody wanted to know what I thought of this guy and that guy. Are we going to keep this guy? I mean, but it was an interesting time. We earned our clients' trust through that period, and it was a period of great opportunity because there was so much turmoil that clients were looking for advice, looking for capital, There was so much work to do that people in the middle of their career got a lot of opportunity to step up and do some really interesting things. Um, and look, when I say they needed capital, capital comes in a dozen different flavors, right? And so while I was fortunate to be at a firm like JPMorgan that has the ability to lend money, we also had the ability to source dozens of different types of capital to fit our clients. So, we worked on things where we were working on workouts. I was working on uh, equity offerings, IPOs, which is an initial equity offering. We were doing bond deals, high yield bond deals, which are not that common in the REIT space. But we were doing a lot of high yield bond deals, mortgage loans where we could. The mortgage market was tough, but there were still some liquidity there. We're doing convertibles, a lot of converts, a lot of preferred equity. People weren't sure they wanted to own the common. They wanted to sit in a different position in the capital stack. That's another alternative that we could present to our clients in terms of issuing a different flavor of capital that might be accretive to them, maybe not today, but over the long term as they recover. So there's lots of different opportunities to provide different types of solutions to our clients, and that's really informed in a very big way how I approach deal making today. What I bring to the table when I'm talking to sellers, when I'm setting up the capital structure of my own company, when I'm talking to sellers of properties that we want to buy, I'm able to present them deals. First, I try to figure out exactly what it is they're trying to achieve through a sale, right? It's especially in the self-storage sector where the number of mom and pops sort of by number outnumber the number of institutional players, especially the mom and pops as sellers far outweigh the number of institutional sellers, right? So, getting down to the motivation for the sale is important because cash may not always be the answer. If that's the answer, then we have cash too. But, cash may not always be the answer. There's very often we find ourselves in situations where we're negotiating with families that have 4 adult children, ready to sell the family jewels. Not everybody wants cash. Some people have a tax problem. Some people want to continue to participate. Some people want to roll. Some people want to be involved at the parent company level. There's all sorts of different things. And if people want to stay involved in the asset, there's 100 different ways to do that too. They can stay involved in the asset at the portfolio level. They can stay involved in the asset by seller financing, rolling some stock, taking a preferred equity piece. I remember one of the last M&A deals I did at Greenhill, where I ran REIT M&A for a couple of years. We sat in it was a data center deal, and we were sitting in a conference room with the guys that were going to finance. It was $1 billion financing to recapitalize this data center business that had just sold all of its assets, and we were done with the deal. And the bags were in the corner, and people were going to the airport at 3. And I was representing the business, and the capital provider raised their hand and said, "There's one more thing."
Oh.
So, okay, what's that? Well, we'll give you the money, but we want to, we're going to have our economics in the PropCo, which is like, I don't remember, 90, 95, 98% of it. But we also need to own a part of the operating company. Okay, well, that's interesting. Okay, let me explore that a little bit more. Understood that a little bit more. Took my client into the conference room, and they were throwing their hands up. And what do I? It's 12. Yeah, we're going to figure this out in 3 hours. I said, so, what do you want? Yeah. They're not doing this deal without it. So, what do you want? I'm like, well, actually, we were a little shy to bring it up, but what we need is the opportunity to get rid of this non-compete and do X, Y, and Z, which would actually benefit the operating company. I said, I'll be right back. Went into the other room and I said, okay, but they want X, Y, and Z. And they said, okay. Everyone was early to the airport. Done.
Yeah.
So, getting down to the motivations, what people need, learning not to say no, but learning to ask why is in my view, the key to deal making.
I'm fascinated by this. It takes me back to your conversation about the role you played in rugby, right? Like the goal is to win. It's not to
Just
be
win,
the
baby.
glory.
Just win, baby. That's right. That's right. It's setting up our clients to win, right? It's setting up our clients to win. And I was pushed into a position where I needed to dig deeper into my clients' needs. Now I knew what their initial needs were. The initial needs were we just sold a giant portfolio of data center real estate and we need to recapitalize.
Mhm.
Pushed further, I found out more and was able to make a deal.
It's fascinating how sometimes you just keep asking questions, and sometimes the problem illuminates a question that you never would have gotten the answer for
Yeah,
otherwise. But when you stay calm and you handle it, you end up finding a solution that ultimately can end up better than what would have otherwise happened. I
100%.
wanna I wanna start talking about storage. We're in for me, a fascinating era. I got into self-storage. I'd never heard of it until well, I'd heard of it, but never really understood it as an asset class until 2019. Got involved in the business in 2021. Obviously, the height of COVID and everything, like you could make a mistake and still do really well in storage. 2026 a very different environment, right? You can't just go out and buy something and expect it to have a 3x return in 2026. Talk to me, and I want to kind of attach this to what you talked about earlier with mom and pop. The reality is it is becoming more institutional, right? Yes, mom and pop still represent the larger amount of sellers, but competing in the market today feels different than it was even 5, 6, 7 years ago. Talk to me about your approach at Next Century and how you're handling what's been a transitional time in the industry.
Yeah. I mean, part of the genesis story here for Next Century was a pivotal um, dinner that I had in Kansas City. One of my clients, investment banking clients, was the CEO of a REIT headquartered in Kansas City. We'd been talking about self storage quite a bit. Um, I went out to have dinner with him. He invited a self storage buddy of his, who happened to be Dan Miller, the inventor of Store Edge, right? And I think you can call him an inventor, right? He developed it. He developed Store Edge, right, from scratch. And we got to talking about self storage and automation. He walked me through. When I got back to New York, him and his guys, we got on a screen just like this, and they walked me through all of what they do. And I said, "How much does all this cost?" And he walked me through the pricing, and it was something like $799 install and $79 a month or something like that. I'm like, Dan, why do you price your product that way? It doesn't
Yeah.
even approach the economic value of the customer, right? I mean, the alternative being like an Excel spreadsheet, right? And he let me in on that's when we started to unpack the prop tech paradigm that had started to emerge in self storage. And the reason why he priced his product that way, and what makes it, which has a corollary to why we approach self storage in this through this lens of unmanned and virtually managed operating models, is he let me in on the secret, which is other than the top 10, 15, maybe 20 largest self storage owners in the country,
Yep.
when he's out there selling a piece of software, which storage is, right? When he's out there selling a piece of software, he's dealing with people that own between 1, 2, and 3 self storage facilities. And these are folks that, God bless them, but ex firefighter, ex police officer, guy used to drive the UPS truck in town, whatever. Their math is, they're not doing ROI math or IRR math or even payback period math. Their math is, I clear $5,000 a month on this facility. Dan wants $4,000 install for this software. I can't make my truck payment. That's the math. So he's got to price. Prop tech people in this business have to price low friction to get them in and then basically run a subscription model, right? And so, and if you have a good product, the revenue will be sticky, and you'll make your return as the prop tech provider, right? So that's the model. That sort of extrapolates into the rest of the prop tech paradigm in prop tech market that services self storage, which creates this opportunity, or at least reduces the barrier to automating your self-storage operations, because now I can also recapitalize differently than the guy that used to drive the UPS truck, but we can also leverage that pricing paradigm to transition properties that are appropriate for a remotely managed model very cheaply into an operating model that saves us about 50% of the property management expenses per month. And so that the cost to transition into that model is very low. The ROI on that, because I did calculate it, is very high.
As I would expect a guy who spent 25 years on Wall Street to do. Couple things I want to ask you. I try and honor 30 minutes on this podcast, both for you and your time, but also for the folks watching so they can absorb. Two things I'd be remiss for sure, right? Last couple of years have been challenging from an interest rate hike standpoint. Of course, you were on Wall Street for 25 years. We went on a run where interest rates, I think I got my first mortgage in 2003 and I was at 5.625. It was the lowest it had ever been the day I signed my mortgage. But we've lived in this 25 plus year period where interest rates have been low. I'm fascinated to get your take with the career you've had. Are we going to hold here for a while? Are we going to see rates start coming back down again? Do we see rates go up a little bit? I'd love to get your take on that and how you see what's playing out in financial markets.
Yeah. Well, look, I'm not gonna prognosticate on the 10-year Treasury 1 or 2 years forward, but I'll tell you what I see. I see the Fed cutting the short end of the curve several times last year. I see the market knowing that there'll be more cuts this year, and we're not seeing analogous reductions in the long end of the curve. The primary cause of that is investors' fear of inflation, right? Those dollars will be worth less 10 years from now, and so I want more of them, right? I think really positive. I'll make it quick because I'm looking at the clock too. What I think what is not well communicated is that inflation is coming way down. Prices don't go down.
Right.
They don't go down. They grow quickly or they grow slowly. But if you look at the CPI over the last 100 years, there is one very short period right after World War II where it went negative. So CPI is not going negative. And commodities will move up and down based on supply. You can pump more oil and the cost will go down. But in general, CPI doesn't go down. It just goes up fast or slow. And so what this economy looks like is low inflation and higher wage growth. And that's the stimulus that we're anticipating. As that starts to come into the market, which I don't think we'll see until everyone pays their 2025 taxes, right? We'll see more of that. The long end of the curve will come back down.
Appreciate that's a fascinating outlook, and I haven't heard that. I've been worried that the 10-year is not coming down when you see those rate cuts and the 10-year doesn't move. But your point about 2025 tax returns shedding a lot of light on what's going on is fascinating. I'm gonna look forward to paying attention to that. Now, last question I want to ask you: the news came out yesterday. Department of Worker and Consumer Protection in New York City sues Extra Space. Faulty, misleading. Talk to me about what's going on in the industry. And you're based out in New York. You live in Chappaqua, a little bit north of the city, spent a lot of time in New York City. What does this mean for the industry? And overall, is it a frivolous lawsuit in your opinion? Is it something that has some legs to it? And what do we have to be thinking about as an industry?
Yeah, I mean, look, Thaddeus, I think I'd approach it this way. I don't know anything about the lawsuit. I read the news reports, but I'm not a lawyer. But I would say this: I think the current paradigm that I'll take it from the business approach, not the legal approach. the current paradigm that we're in with very low move-in rates, very high ECRIs is just not sustainable from a long-term marketing perspective. And I'm talking about marketing to our customers, our end users. We've gotten away with it for a couple of years. It's not necessarily just municipalities that are sort of rattling sabers about this paradigm. I'm not making a judgment as to whether it's fair or not. I don't really have an opinion on that. I don't think from a go-to-market strategy, it's sustainable, right? So some force, whether it's customers demanding something different, municipalities suing on behalf, consumer advocates rattling sabers in the news, some force is going to rationalize the way we price our units and go to market with our units.
Cannot thank you enough for sharing your insight. This has been an absolute blast for the last half hour. I learned a ton, which is my favorite part of doing this podcast. I tend to get to be the one that learns the most. If somebody wants to, I just lost my AirPod. If somebody wants to reach out to Adam Troso with an opportunity, a storage facility that may be selling, you can see his email on the screen. Tell me what's an ideal opportunity for you and what you're looking for.
We like small, medium-sized self-storage facilities. We prefer drive-up. We like buy level, taller than 2 stories is a maybe. We focus on east of the Mississippi plus Texas, but we're not, religious about that. But that is our primary geographic focus, just based on our view of demographics and portfolio construction.
He's the CEO and founder of Next Century Self Storage. Really, really grateful that you chose to take the time to come and share the story with us. I'm going to give one last shout out to my friends at Kiwi 2 Construction, 30 plus years of providing steel structures for ground up development in the self storage business. Also very active in the small bay industrial space. If you're doing some small bay flex, reach out to Wayne Woolsey and his crew. You can reach them at kiwiconstruction.com. I am your host, Thaddeus Campbell, and that is it for this week's episode of the Stories Behind the Door podcast. Thanks for joining us.
Thanks, pal.